It is over, and I mean completely over, for anyone who did not see this coming. Bitcoin just crashed from $134,200 to $91,200 in less than 10 hours. And the SEC investigation that exploded overnight is about to destroy what is left of this market. If you are still holding crypto right now, you need to stop everything you are doing and listen to every single word I am about to say. The mainstream media is lying to you about what really happened, and the people who orchestrated this crash are counting on you to stay confused. I have spent the last 48 hours analyzing every transaction, every regulatory filing, every whale wallet movement, and every on-chain signal from the crash. What I discovered will make you question everything you thought you knew about this market. This was not a random crash triggered by panic selling or weak hands getting shaken out. This was a coordinated takedown executed by institutions, market makers, and regulators who had been planning this for weeks. By the end of this video, you will know exactly who set the trap, how they triggered it, and why February could be even worse. But first, I need to know who is watching this right now, because what I am about to reveal could save your entire portfolio. Pause and comment your location: New York, London, Singapore, Dubai, Mumbai, Tokyo, Sydney. We are building the most informed and sophisticated crypto community on the entire planet, and I will personally reply to as many of you as I possibly can within the first hour after this video goes live. Let me show you exactly what happened, because the timeline reveals coordination most traders missed. The crash started 3 weeks before January 29th, when the seeds were planted. January began with Bitcoin at $89,200, recovering from a December pullback most analysts dismissed. Institutional wallets were already moving in ways that suggested something bigger was coming. On January 3rd, over 42,000 BTC moved out of wallets dormant for 3 years. These were traced to sovereign wealth funds and family offices, positioning for a major move. Grayscale Bitcoin Trust saw its largest inflow since converting to ETF. $890 million in 24 hours. This was institutional capital entering through compliant regulatory channels. Bitcoin barely moved, crawling from $89,200 to $91,400 over 3 days. The lack of movement, despite massive inflows, was the first red flag. Someone was absorbing buying pressure. On January 6th, the Treasury confirmed stablecoin reserves backed by U.S. Treasuries surpassed $180 billion. This shifted the institutional narrative overnight. Blockchain was now a strategic asset. Bitcoin jumped 4.2%, closing above $95,000 for the first time since mid-December. The real action was in derivatives, where open interest spiked 18% in one session. Leverage positions were being built at an unprecedented pace across all exchanges. Whale wallets holding over 1,000 BTC added 14,200 BTC between January 7th and 10th. This was the largest 3-day accumulation in 12 months, yet media ignored it completely. The smart money was loading the boat while retail scrolled past the headlines. Funding rates stayed neutral during this phase, meaning the market was not overheated. Professionals were building positions without triggering the euphoria that marks a top. By January 12th, Bitcoin hit $103,400, breaking above $100,000 for the second time. Unlike December, it held above 6 figures for 3 days before pulling back. Ethereum surged from $3,200 to $3,190 as Layer 2 adoption hit all-time highs. The broader altcoin market was stirring, but real mania had not begun yet. On January 14th, a leaked memo from a major bank surfaced on social media. The memo outlined plans to offer Bitcoin as a reserve asset, and it went viral within hours. The bank never confirmed the memo, but the market didn't wait. Bitcoin surged $8,000 in one session, from $103,400 to $111,600, the largest single-day gain ever. Social media exploded when the memo went viral. Reddit threads hit millions of views, and TikTok creators pumped out Bitcoin to $200,000 videos nonstop. Retail inflows into Bitcoin ETFs hit $2.3 billion on January 15th, shattering records by 40%. These were individuals pouring savings into a market that had gone parabolic. The leverage building was staggering. Total open interest jumped from $38 billion to $67 billion in 1 week, a 76% increase. Funding rates turned sharply positive, meaning longs were paying shorts to stay open. This is a well-documented warning sign of dangerous overleverage and vulnerability. By January 18th, Bitcoin hit $119,800, and fear and greed spiked to 94. It was trading 140% above its 200-day average, a level only seen in 2017 and 2021. Altcoins went vertical during peak euphoria. Solana surged 95% to $420, while meme coins posted 200% to 500% gains. The greed was reaching levels that historically mark exact tops. On January 20th, a crypto influencer posted, "Bitcoin is going to $250,000 in February." The video hit 30 million views in 48 hours, flooded with screenshots of 10x to 50x leverage. While retail celebrated, whale accumulation reversed. Wallets holding over 1,000 BTC moved coins to exchanges at the highest rate all year. This distribution was buried under retail mania. Almost nobody noticed smart money was walking toward the exit. The on-chain data was screaming sell, but retail was screaming buy. January 23rd saw Bitcoin touch $128,000 before closing at $125,400. A perfect shooting star formed, a textbook reversal signal, but nobody cared anymore. On January 24th, Trump endorsed crypto adoption as part of his economic strategy. He hinted at executive orders, and Bitcoin jumped another $6,000. The political endorsement was the fuel retail needed to go all in. By January 25th, total crypto market cap crossed $4.2 trillion for the first time. Media that dismissed Bitcoin for years were now calling it the Great Crypto Awakening. Derivatives, data was screaming danger, but warnings were drowned out by noise. Liquidation levels below $100,000 had accumulated to over $28 billion in forced selling. The powder keg was built and ready to explode. January 26th saw Bitcoin hit $134,200 before violently rejecting to $130,800. The $2,400 rejection wick was the largest in Bitcoin's history. On January 26th evening, something happened that would trigger the collapse. 3 hedge funds managing $180 billion held an emergency meeting to coordinate their exit. This was the moment the trap was finalized. These funds had locked in $3 billion in profits since early January. They decided to unwind positions over 48 hours in a carefully orchestrated sequence. January 27th opened at $132,000 and selling began quietly. Price only dipped 1.2% to $130,400. Most analysts dismissed it as consolidation, but under the surface, billions were quietly exiting. Hedge funds exited through dark pools, bypassing visible order books. The Fed released December minutes with one sentence buried deep that analysts overlooked. The Fed stated, crypto posed emerging systemic risks that warrant closer monitoring. This was the first time crypto was classified as systemic risk officially. The regulatory walls were closing in and nobody was paying attention. January 28th was the calm before the storm. Bitcoin traded between $129,000 and $131,000, while fear and greed stayed at 91. Retail held positions with full confidence, unaware the ground was crumbling. By midnight, the 3 funds had completed 60% of their exit. The final 40% would be triggered by the crash itself. Now pause and be honest with yourself. When Bitcoin was at $131,000 on January 28th evening, what did you do? Did you take profits or add more thinking $200,000 was coming? Comment to I sold or I held. No judgment, only lessons. Then January 29th arrived and everything built over 4 weeks was destroyed in 18 hours. 3 events hit within hours, and the combination was catastrophic. At 6:47 a.m. Eastern, a major Cayman Islands exchange halted all withdrawals for security maintenance. Within minutes, insiders leaked it was facing a $1.4 billion liquidity crisis from an overnight hack. The first domino had fallen. On-chain forensics confirmed it was an inside job. Bitcoin dropped 3.8% in 20 minutes, falling from $131,000 to $126,000. At 9:15 a.m. Eastern, the SEC dropped the second shock. They announced an emergency investigation into 3 major Bitcoin ETFs, citing serious irregularities that may constitute fraud. The second domino fell immediately after. The SEC language was deliberately aggressive, suggesting criminal activity. Bitcoin fell another 5.2% in 30 minutes, crashing through $119,000 as institutions rushed to redeem. The third catalyst arrived at 10:30 a.m. and sealed the market's fate. A whistleblower posted proof that 3 major market makers had been suppressing sell pressure for 2 weeks. Market makers had absorbed sell orders on one exchange while placing synthetic buys on others. This meant price action from January 20th onward was manipulated. Real demand was much lower. The third and final domino crushed everything. The sell-off transformed into full panic within minutes. Bitcoin collapsed from $119,000 to $105,000 in under 1 hour, the fastest decline ever. Forced liquidations exploded across every exchange. Within 2 hours, $8.7 billion in longs were liquidated. 30% of open interest evaporated. Exchanges had never seen anything like this before. The margin cascade hit hardest among retail with 10x to 50x leverage. Thousands of accounts were wiped to zero within minutes. By noon, Bitcoin had fallen to $97,400. Total market cap dropped from $4.2 trillion to $3.1 trillion, so $1.1 trillion destroyed. The panic accelerated throughout the afternoon. Algorithmic systems that chased momentum up now amplified every decline down in a feedback loop. Ethereum crashed 42%, falling from $3,700 to $2,150. Solana dropped 58%, and meme coins lost 70% to 90% of January gains. On-chain data revealed whales that distributed since January 21st resumed buying below $95,000. The same wallets that engineered the sell-off were accumulating at the bottom. By 4 p.m., Bitcoin found a floor at $91,200, exactly where it was on January 5th. 4 weeks of gains erased in under 10 hours. The aftermath devastated the global crypto ecosystem. A major DeFi protocol suffered $340 million in liquidations as collateral might collapse faster than oracles could update. The entire DeFi ecosystem was on the brink of systemic failure. In South Korea, regulators launched an investigation after 12,000 retail investors lost everything. The average loss was $47,000, mostly first-time investors from January. Bitcoin closed at $91,800, technically positive for the month by 2.9%. The January candle formed the most dramatic shooting star reversal in Bitcoin's history. Every technical analyst on the planet circled this candle in red. Now, let me tell you what this means for February. The technical damage from January 29th will take significant time to repair. The critical support is $88,000 to $91,000, tested on January 29th. If Bitcoin closes below $88,000, the next support is $82,000 to $85,000. Resistance levels are equally important. The $100,000 to $103,000 zone has flipped to resistance and will cap rallies until the SEC investigation concludes. Historical data for February is concerning. Bitcoin declined in 6 of the last 8 Februaries with an average return of negative 8.3%. The SEC investigation adds massive regulatory uncertainty. Until it concludes in 4 to 8 weeks minimum, large institutions will stay on the sidelines. The manipulation allegations will likely trigger congressional hearings in February or March. The negative headlines alone will create sustained downward pressure on sentiment. The bullish case relies on structural adoption remaining intact. The long-term fundamentals didn't disappear just because price crashed 31%. Veteran traders who called the top are positioning for a bounce. They argue the liquidation flushed weak hands and the market needs 2 to 3 weeks to rebuild. On-chain metrics showed significant whale buying below $93,000 in the final hours. This suggests sophisticated holders view current levels as an accumulation opportunity. The bearish case is equally compelling. The manipulation revelations damaged retail trust, and confidence could take months to return. Until investigations conclude, overhead supply from traders trying to break even will cap rallies. This overhead resistance will dominate February. Most analysts expect February to trade between $85,000 and $103,000 with downward bias. The real opportunity emerges in March or April if Bitcoin holds $85,000. Now that you've seen the complete picture, the accumulation, the mania, the exit, the crash, and the investigation, one question remains: what is your plan for February? Are you buying at $91,000 or waiting for $85,000? Give me your strategy and price target in the comments right now. If this gave you clarity no other video has, hit that like button now. The bull market isn't dead, but easy leveraged gains are over. February is not the month to chase headlines. It's the month to accumulate quietly and prepare for what's next. The weak hands are washed out and tourists have left. What remains is the brutal two-way market that experienced investors know. For those with patience and dry powder, January 29th was an invitation. Subscribe and turn on notifications. We track every whale movement through February. The $85,000 level is the line in the sand that will determine everything that happens next. If that level holds through the entire month, we could see a powerful reversal set up by early March. But if $85,000 breaks and we close daily candles below it, the next stop is $75,000 to $78,000, which represents complete retracement of the January rally and signals a much deeper bear market ahead. The volume profile data from the crash reveals something absolutely critical that most traders are completely missing. The highest volume trading node during the entire sell-off occurred precisely between the $93,000 and $97,000 price range, which means this exact zone will act as absolutely major resistance on any attempted recovery moves back up. Professional institutional traders are watching the weekly candlestick close far more carefully than the daily noise and volatility. If Bitcoin can successfully close this current week above the critical $92,000 level with decent volume, it would strongly suggest that the absolute worst of the panic selling is completely over and that smart accumulation can begin relatively safely. The options market is pricing in extreme volatility for February, with implied volatility hitting levels not seen since March 2023. This means option sellers expect massive price swings in both directions throughout the month. Exchange reserves of Bitcoin are actually declining significantly in the days immediately following the crash. which historically indicates that panic sellers are completely exhausted and have no more coins left to sell. When coins consistently move off exchanges and into cold storage wallets after a major capitulation event like this, it typically marks the very beginning of the next major accumulation phase by smart money. The correlation between Bitcoin and traditional risk assets has completely broken down post-crash. While Bitcoin crashed 31%, the S&P 500 actually rallied on the same day, suggesting that crypto is being treated as an isolated event rather than systemic contagion. And this decoupling is actually bullish medium term because it means institutions are not viewing crypto as a threat to the broader financial system. The Bitcoin network hash rate has not dropped at all despite the massive 31% price crash we just witnessed. Miners are absolutely not capitulating or shutting down their operations, which historically indicates very clearly that they firmly believe current depressed prices are completely temporary and that profitable mining economics will return very quickly in the coming weeks. Network fundamentals remain incredibly strong with daily active addresses still elevated, significantly above 2023 averages. The actual real infrastructure usage and adoption did not collapse whatsoever with price, which suggests that genuine real adoption continues building steadily beneath the speculation layer. Lightning network capacity actually increased during the crash as users moved to cheaper Layer 2 solutions. This type of behavior during bear markets historically precedes the next major bull run. The developer activity on GitHub for major Bitcoin projects has not slowed. When developer commitment remains high through price crashes, it signals that the long-term vision is intact regardless of short-term volatility. Institutional custody balances at Coinbase and Fidelity have not seen significant outflows. The smart institutional money that entered through proper channels is not panic selling. They are holding through the storm. The regulatory clarity timeline is becoming clearer with the SEC investigation expected to conclude by mid-March, and the market will likely remain range-bound until that conclusion provides direction. Congressional hearings on the manipulation allegations are scheduled tentatively for late February, which will create short-term headline volatility, but could ultimately provide the transparency and accountability needed to restore long-term retail confidence in these markets. The market needs to see arrests or enforcement actions against the manipulative market makers. Without accountability, retail confidence will remain permanently damaged, and the next bull run will struggle to achieve escape velocity. Watch the USDT and USDC supply metrics throughout February. If stablecoin supply starts increasing again, it signals that new capital is moving to the sidelines waiting to deploy. The fear and greed index has crashed to 18, which is deep fear territory. Historically, when this index drops below 20, it marks near-perfect buying opportunities for patient accumulators. Sentiment on social media has completely flipped from euphoria to despair in just 72 hours. The number of Bitcoin is dead articles being published is approaching levels last seen in late 2022 when Bitcoin was at $15,000. And this extreme negative sentiment is actually a powerful contrarian bullish signal because markets historically bottom when absolutely everyone capitulates and throws in the towel, not when people are still holding on to hope. I'll see you in the comments and in the next video when we break down the first week of February.